Friends, can you believe it? The U.S. stock and bond markets, as well as the gold market, are all simultaneously sending us unprecedented signals. Non-farm payroll data was devastating, with hundreds of thousands of jobs vanishing out of thin air. Meanwhile, gold prices hit record highs as central banks frantically bought gold. Goldman Sachs declared, "The stock-bond balance is completely broken." If you're still holding onto stocks and bonds, it's like standing in a burning house without a fire extinguisher. For decades, everyone believed in the ironclad principle that when the stock market falls, the bond market will support it, and when the bond market falters, the stock market can provide a boost. Investors felt they had double insurance, protecting them from total destruction. However, reality is showing us that this protective umbrella is beginning to fray. Don't think I'm exaggerating. On September 2nd, global markets experienced a rare double-dip sell-off of stocks and bonds. The next day, Goldman Sachs published a research report claiming that the world was entering a new commodity control cycle. Many people didn't grasp the significance of this statement at the time, thinking it was just more playful Goldman Sachs rhetoric. However, the market didn't give you time to react. Within 48 hours, 3 resounding blows followed. The first was the devastating U.S. non-farm payroll data. On September 5th, the Department of Labor released data for August showing only 22,000 new jobs. That's right, not 220,000, but a mere 22,000. It's like a company vowing at the beginning of the year to hire 100 top employees, but only finding 2 by the end of the year. Isn't the discrepancy outrageous? The market had expected 150,000 to 170,000 new jobs, but only a fraction of that number were created. Even worse, the unemployment rate soared to 4.3%, a 4-year high. This was also the first negative monthly revision since the start of the pandemic in 2020. What does this mean? They claimed there were jobs, but there simply weren't that many. It's like your account book says you'd made money, but at the end of the year you realize it was all an illusion. The illusion of prosperity in the U.S. labor market is gradually crumbling. The second blow came from the performance of gold. In early September, the international gold price surpassed $3,600 per ounce, setting a new record high. This time, however, it wasn't impulsive individual investors who drove the price up, but rather a vote of no confidence cast by central banks and large institutions using real money. According to the World Gold Council, global central banks have purchased more than 1,000 tons of gold annually for the past 3 years, reaching 1,045 tons in 2024, a 70-year high. You can think of this as central banks buying insurance for themselves. Why do they do this? Because they are worried that the old car of the U.S. dollar might break down at any time. Gold, on the other hand, is like a Jeep that can withstand war, crisis, and stormy weather. This demonstrates that gold is not merely an investment product, but also the ultimate survival currency. The third blow came from the rebound in rare earth and lithium prices. From late August to early September, prices of these elements rebounded strongly. The reason is simple. China dominates the core of the new energy industry chain. 90% of rare earth refining and 70% of lithium refining occur in China. It's like if one person controlled 90% of the water you drink every day and could instantly double your cost of living by shutting off a single valve. This is the reality of the global new energy vehicle and battery industries. The market has already priced in this uncertainty. After these 3 developments, the conclusion is clear. The stock market is unstable, the bond market is failing, gold prices are at record highs, and commodities are sending out warning signs. Taken together, these developments reinforce Goldman Sachs' statement that the protective umbrella of stocks and bonds, which has shielded us for the past decade, is crumbling. The only safety net is quietly shifting from stocks and bonds to commodities. This isn't just a cold research conclusion, it's an unfolding reality. Today, I want to discuss the true significance of this shift. Why is the stock-bond portfolio failing? What is the control cycle for commodities? More importantly, how should ordinary investors adjust their positions in this massive transfer of wealth to survive or even strike back? To understand why stock-bond portfolios fail, it is first necessary to consider two critical circumstances: institutional credibility and supply shocks. Institutional credibility refers to the market's trust in central banks and governments. Once this trust is shaken, both the stock and bond markets will collapse. It's like a doctor prescribes medication, but everyone suspects he's been bribed by pharmaceutical companies. What would be the result? No matter what the doctor prescribes, the patient won't trust it. The United States in the 1970s is a classic example of this. An oil crisis erupted, inflation spiraled out of control, and the Federal Reserve was slow to respond. The stock and bond markets both plummeted, while the gold price soared. What about today? The non-farm payroll data was devastating. Unemployment soared, and the Federal Reserve was forced to cut interest rates. However, if inflation returns, the central bank's credibility will be completely shattered. Losing credibility would be even more devastating than the evaporation of assets. Another scenario is a supply shock. This occurs when supply chains are disrupted, causing the economy to stagnate and prices to soar, rendering stocks and bonds equally ineffective. In 2022, for example, Russia cut off natural gas to Europe, causing prices to increase tenfold, factories to shut down, and the economy to collapse. The stock and bond markets both plummeted, with commodities being the only survivors. Today, rare earth, lithium, grain, and shipping pose similar risks. A stock-bond portfolio is like a house without a firewall. If a fire breaks out, there's nothing you can do but watch it burn down. That's why Goldman Sachs says we're entering a new commodity control cycle. In other words, resources aren't just an economic issue anymore. They're also a geopolitical weapon. There's a clear logic behind this. Commodity prices affect the entire world. Resources are concentrated in a few countries, which intensifies geopolitical tensions and rewrites market rules. Gold is a prime example. Central banks frantically buying gold signals a lack of confidence in the dollar. Rare earths are even more obvious example. China controls 90% of the refining process. Once policies tighten, the costs in the new energy supply chain will skyrocket. Whoever controls the resources can rewrite the market rules. This raises the question, what should ordinary investors do? History has already provided the answer. Gold is the only asset that can defy the trend and surge during stagflation. In the 1970s, for example, the price of gold rose from $35 to $850, a 24-fold increase. Today, central banks are frantically buying gold. Isn't this a clear signal? There's still opportunities in the stock market. For example, energy companies can pass on costs to consumers, which directly benefits commodity-related companies. Financial stocks can widen their interest rate spreads in a rising interest rate environment. Additionally, the stable cash flows and dividends of value stocks will become more popular. Conversely, highly valued tech stocks, bond-like stocks, and consumer discretionary stocks will all suffer. What about bonds? They are a slow-acting poison in a stagflation environment. Inflation erodes real returns, and rising interest rates depress bond prices. Currently, the yield on a 30-year U.S. Treasury bond is close to 5%, but the actual return may be less than 2%. Long-term bonds carry significant risk. The most reliable approach is diversification, including holdings in gold, defensive stocks, undervalued markets, and cash reserves. True experts don't predict the future, they prepare for it. History is the best teacher. In the 1970s, the United States experienced a lost decade. Inflation soared to 12%, unemployment exceeded 7%, and the economy nearly stagnated. The stock market failed to generate profits. The bond market suffered heavy losses, and only gold and energy stocks emerged victorious. Finally, Federal Reserve Chairman Volcker raised interest rates aggressively, pushing them above 20% in an attempt to curb inflation. However, the price paid was an unemployment rate exceeding 10%, and the economy plunged into a severe recession. With U.S. debt levels far higher today than they were then, can the Fed repeat Volcker's strategy? The answer is likely not so simple. This means future market volatility will only intensify. So friends, the so-called stock-bond balance is like a house without a fire protection. If there's a fire outside, will you stay inside or seek new safe havens? History doesn't simply repeat itself, but it certainly rhymes. The great wealth transfer of the 1970s shows us that while most people lose money, a few who are prepared can seize the opportunity. The question is, this time, will you hold on to stocks and bonds or shift into gold and commodities? I'd love to hear your thoughts. Do you think gold will emerge as the ultimate winner as it did in the 1970s? Let me know in the comments and let's learn and grow together. Don't forget to like, subscribe, and hit the bell. Next time, I'll continue tracking this great wealth transfer and help you stay on the winning side.